Did you know you can lock in a massive 15% annual yield, paid out every single month, backed by none other than Warren Buffett's investing playbook? That's right, folks. I'm talking about the VistaShares Berkshire Select Income ETF, ticker OMAH, the 2025 game changer that's got JEPI and JEPIQ investors wishing they'd jumped on board sooner. Today, I'm spilling the beans on whether this Buffett-fueled income powerhouse is your golden ticket to passive wealth, or if you're smarter sticking with the classics. Hang tight. I'm giving you the whole truth, including the risks others dodge. Let's dive in and see if OMAH's your next big win. This is not financial advice and is for entertainment purposes only. Why Warren Buffett and OMAH? When you hear Warren Buffett, you think of the greatest investor of all time. For decades, investors have tried to emulate his success by buying shares of Berkshire Hathaway, ticker BERK.B, a powerhouse of blue-chip companies handpicked by the Oracle of Omaha. But there's a catch. Berkshire doesn't pay dividends. Buffett reinvests profits to fuel long-term growth, which has created staggering wealth. $100,000 invested in Berkshire in 1980 would be worth over $5 million today. That's phenomenal, but for income-focused investors, it's a problem. What if you want Buffett's genius and monthly cash flow to cover bills, reinvest, or fund your lifestyle? Enter the VistaShares Berkshire Select Income ETF, ticker OMAH. This fund isn't just a clone of Berkshire Hathaway, it's a reimagined version engineered to deliver Buffett's top holdings with a twist, a targeted 15% annual yield paid out monthly. OMAH takes a curated selection of Buffett's best stocks, think Apple, Coca-Cola, American Express, and uses sophisticated option strategies to generate consistent income. It's like strapping a cash flow engine onto Buffett's portfolio, giving you the best of both worlds, exposure to world-class companies and a steady paycheck. But is it too good to be true? Let's unpack the three pillars that make OMAH stand out in the ETF landscape. The three pillars of OMAH. First, OMAH is all about high monthly income. With a target of 15% annual yield distributed monthly, it's designed to deliver serious cash flow. For example, a $100,000 investment could generate about $1,250 a month, $15,000 a year. Compare that to traditional dividend stocks like Coca-Cola, yielding around 3%, or even popular income ETFs like JEPI, 7 to 9%, or JEPIQ, 8 to 11%. OMAH's payouts dwarf them, offering a lifeline for retirees needing income or younger investors looking to reinvest and compound wealth. Imagine covering your mortgage or car payment with those checks. That's the kind of real-world impact OMAH aims for. Second, it provides core equity exposure to a diversified portfolio of large and mid-cap companies. OMAH holds roughly 20 of Buffett's top picks, blue-chip giants known for stability and profitability. These are the kind of businesses Buffett loves, durable, cash-generating machines with strong moats. Unlike single-stock ETFs tied to volatile names like Tesla or MicroStrategy, OMAH's holdings are built to weather market storms, giving you a solid foundation while still chasing that high yield. Third, OMAH leverages professional options management. The fund uses a data-driven covered call strategy handled by experienced pros who navigate the complex world of options trading. For most retail investors, selling covered calls effectively is a headache picking strike prices, managing expirations, and monitoring volatility isn't easy. OMAH's team does the heavy lifting, using algorithms and market insights to maximize premium collection while balancing risk. It's like having a team of Buffett disciples running your income strategy, leaving you free to focus on your financial goals. Who is OMAH for? So, who's the ideal investor for OMAH? Let's break it down. If you're nearing retirement or already retired, OMAH could be a game changer. That 15% yield means reliable monthly income to cover living expenses, travel, or hobbies without selling off your portfolio. For example, $200,000 in OMAH could generate $2,500 a month, enough to fund a comfortable lifestyle or supplement Social Security. If you're a portfolio diversifier, OMAH is also a strong contender. Maybe you've got growth stocks or index funds but want to add an income component without sacrificing quality. And if you're a Buffett fan who's always wished Berkshire paid dividends, OMAH feels like a dream come true. You get exposure to Buffett's hand-picked companies, businesses he's vetted over decades, plus the monthly payouts Berkshire lacks. But here's a critical caveat. OMAH shouldn't be your only investment. With about 20 holdings, it's more concentrated than broad market ETFs like those tracking the S&P 500, 500 companies, or total market indexes, thousands of companies. For proper diversification, pair OMAH with funds covering other sectors, small caps, or international markets. Even Buffett himself recommends low-cost index funds for most investors, so don't put all your eggs in one basket, no matter how appealing OMAH's yield is. The trade-offs: no free lunch. Now let's talk about the trade-offs, because there's no such thing as a free lunch on Wall Street. A 15% yield sounds incredible, but it comes at a cost. The biggest trade-off is capped upside potential. OMAH's covered call strategy involves selling call options on its holdings, which limits how much you benefit from big price jumps. If Apple surges 20% after a blockbuster iPhone launch, traditional shareholders or BRKB holders get the full 20% gain. But OMAH investors might be capped at, say, 5 to 7% because the calls sold against Apple lock in profits at a set price. You're trading future growth for immediate income. This means in strong bull markets like 2023, when the S&P 500 gained 24%, OMAH will likely underperform Berkshire Hathaway and broader market ETFs. If you're a young investor with decades until retirement, that capped upside could cost you significant wealth over time. Tax implications are another hurdle. OMAH's distributions are classified as ordinary income, not qualified dividends. Qualified dividends, like those from Coca-Cola, max out at a 20% tax rate. But ordinary income could be taxed at 37%, depending on your bracket. For a $10,000 annual yield, someone in the 24% bracket would keep $7,600 after taxes with OMAH versus $8,500 with qualified dividends. This tax hit makes OMAH less attractive in taxable accounts. Consider holding it in an IRA or 401k to minimize the drag. Then there's the expense ratio, 0.95%, or $95 per $10,000 invested annually. Compare that to JEPI's 0.35%, $35 per $10,000, or an S&P 500 ETF like VOO at 0.03%, $3 per $10,000. Over 20 years, that 0.95% fee could shave thousands off your returns. You have to ask, does OMAH's active management and option strategy justify the cost? The ultimate ETF showdown. Let's put OMAH head-to-head with JEPI, JEPQ, and BRKB in what I call the ultimate ETF showdown. First, diversification. JEPI and JEPQ win hands down. JEPI tracks the S&P 500 companies, and JEPQ follows the NASDAQ 100+ tech-heavy firms. OMAH, with approximately 20 holdings, is more concentrated, though still safer than single-stock ETFs. For dividend yield, OMAH takes the crown with its 15% target, blowing past JEPI's 7 to 9% and JEPQ's 8 to 11%. BRKB scores a 0, no dividends at all. On dividend stability, JEPI and JEPQ have the edge with proven track records. OMAH is too new to judge, but other covered call ETFs show payouts can wobble in volatile markets. For example, during 2022's bear market, some income ETFs cut distributions when volatility dried up premium collection. Expense ratios favor BRK. B, no fees, as it's a stock, and JEPQ, 0.35%, over OMAH's 0.95%. For total return potential, BRKB shines in bull markets with uncapped upside. Its 50% gain in 2021 crushed most ETFs. JEPI and JEPQ offer moderate growth, while OMAH lags due to capped upside. Tax efficiency also goes to BRK.B, which generates no taxable events until sold, unlike the regular distributions from OMAH, JEPI, and JEPQ, which trigger annual taxes. So what's my take on OMAH? It's an innovative ETF, essentially creating a dividend-paying version of Warren Buffett's portfolio for income-focused investors. The 15% yield is a powerful draw, especially for retirees or those seeking cash flow to cover expenses or reinvest. The focus on blue-chip stocks and professional options management adds credibility, making it a compelling option for specific investors. But there are red flags. First, OMAH is brand new, with a limited track record and potentially low liquidity, which could mean wider bid-ask spreads and trading challenges. Second, the 0.95% expense ratio is steep, nearly triple JEPI's fee and 30 times a typical S&P 500 ETFs. Third, the tax inefficiency of ordinary income distributions makes it less appealing for taxable accounts. Finally, the capped upside means you're sacrificing long-term growth for short-term income, which may not suit younger investors or those in the accumulation phase. If you're intrigued by OMAH, here's my suggested approach. Start small. Allocate no more than 5% of your portfolio, say $5,000 on a $100,000 portfolio, to test the waters. Monitor its monthly distributions over 3-6 months to see if it hits the 15% yield target consistently. Compare its performance to Burkhay.B, JEPI, JEPQ, and the S&P 500 to gauge its value. Hold it in a tax-advantaged account like an IRA to dodge the tax hit, and always pair it with broader ETFs for diversification. Think VOO for U.S. stocks or VXUS for international exposure. For most investors, a balanced approach makes sense. Own BRKB for long-term growth, leveraging Buffett's unmatched track record. Add JEPI or JEPQ for solid income with better diversification and lower fees. Use OMAH as a small, tactical position if you're obsessed with high monthly income and Buffett's philosophy. Let's bring this home with a practical example. Imagine you're 60, semi-retired, with a $500,000 portfolio. Allocating 10%, $50,000 to OMAH, could generate $625 a month at a 15% yield, enough for utilities, groceries, or a car payment. Pair that with 60% in a low-cost S&P 500 ETF for growth and 30% in bonds for stability, and you've got a balanced portfolio that covers income and long-term wealth. If you're 35, like me, you might allocate just 5% to OMAH, using the distributions to reinvest and compound while keeping the bulk in growth-oriented funds to build wealth over decades. What could a 15% monthly yield do for you? Maybe it's paying off debt, funding a vacation, or building a nest egg. For me, it's about freedom, knowing I could step away from work if needed, maybe to spend more time with family or pursue a passion project. How would a monthly 15% yield change your life? Drop your thoughts in the comments. I'd love to hear your plans. If you found this deep dive helpful, smash that like button, subscribe, and ring the notification bell so you never miss an update on game-changing investments like OMAH. Check out our last video for more ETF insights and keep building your wealth. Thanks for watching, and take it easy. This video is for educational and informational purposes only. Investment performance is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult a qualified financial advisor before investing.